So today we'll cover these areas to give you a high-level overview of your Wise Trust pension. We'll talk about what a defined pension plan is, how it works, and how to build your pension. We'll also take a look at the online self-service tool called My Pension Resource. We'll talk about retirement and when you can retire, survivor benefits, and we'll also cover the impact that certain life and career events have on your pension. We'll end with providing you some helpful tips and resources where you can get additional information. But first, let's start with who is Wise Trust. As most of you know, Wise Trust was created a few years back when the WSIB Employees Pension Plan converted from a single employer-sponsored pension plan to a jointly sponsored pension plan, where the joint sponsors, WSIB and OCU, the Ontario Compensation Employees Union, appointed Wise Trust as the administrator of the plan. Our sole purpose is to administer and provide pensions for more than 10,000 workplace insurance and safety workers in Ontario. The members of our plan include active, deferred, and retired former employees from our 6 participating employers: the WSIB, our 4 health and safety associations, who are the Infrastructure Health and Safety Association, Workplace Safety North, Workplace Safety and Prevention Services, and the Public Services Health and Safety Association, and Wise Trust. Wise Trust provides you with the peace of mind knowing that when you decide to retire, you'll have a secure monthly pension for your lifetime. The Wise Trust plan is a defined benefit pension plan that offers security and predictability today and a stable retirement income you can count on for life, even if you live to be over 100 years old. This means you'll be able to better predict upfront what your monthly pension from the plan will be when you retire, and the longer you're an active contributing member of the plan, the greater your pension benefit will be. You won't have to worry about investment decisions, stock market returns or fluctuations, or base your retirement plans around market performance. And once you retire, you'll receive monthly pension payments for the rest of your life. You'll have the security of knowing that you won't outlive your pension. Plus, our plan also provides survivor and inflation protection. We'll get into the details of these valuable benefit features later in the presentation. So who is eligible to join the Wise Trust pension plan? Membership in our plan is mandatory for permanent employees. All full-time and part-time permanent employees are automatically enrolled in the plan on their first day of employment, provided they meet the minimum hours or earnings requirement. If you are a temporary employee hired on a temporary contract basis, joining the plan is optional, where you may elect to join the plan after completing 24 months of continuous employment. Since joining is not mandatory for temporary employees, enrollment is not automatic. So approximately 6 months prior to your 24-month eligibility date, our Wise Trust Pension Contact Center will send you an enrollment package in the mail. You'll need to complete the enrollment form, sign and return it before your eligibility date. Regardless of whether you're a permanent or temporary employee, once you become a member of the plan, membership continues for as long as you remain an employee of one of our participating employers. And once you've enrolled, you'll receive a welcome package in the mail. The package includes the pension plan guide booklet that outlines important details of the plan and a spousal declaration and beneficiary designation form for you to designate your pension beneficiaries. It's important that you complete this form and return it to the Wise Trust Pension Contact Center as soon as possible. You'll also receive an email delivered to your work email address inviting you to register for My Pension Resource, our secure online member site where you can view your personalized pension information and access self-serve pension tools that will allow you to estimate your future pension, initiate your retirement, and much more. If you've been hired recently and have not yet received your welcome package, please contact the Wise Trust Pension Contact Center. We'll share the contact information with you at the end of this presentation. As a Wise Trust plan member, You're planting the seeds for a more secure financial future. We all know how important it is to plan for the future, but with so much to think about every day and the unpredictable twists and turns that life can throw at us, it may feel like saving for your retirement is impossible right now. But your Wise Trust plan makes that possible. And you're not saving for retirement on your own. Your employer is also making contributions towards your retirement. So let's start by looking at the contributions you and your employer make to the plan, and then look at how your pension benefit is calculated and the ways you can continue to build up and maximize your pension. As soon as you're enrolled in the plan, both you and your employer start making contributions that are paid into the pension fund, which is invested and managed for the long term by our investment professionals on behalf of all members. You contribute a percentage of your pensionable earnings based on a set formula, and these contributions are deducted from your biweekly pay, and they're also tax deductible. The amount that you contribute to the plan each year is based on a formula shown here. We will be referencing something referred to as the YMPE. The YMPE stands for the year's maximum pensionable earnings, and this is the maximum salary amount on which you need to contribute to the Canada Pension Plan, and this amount is set out by the government each year. You contribute a certain percent A shown in this graphic, of your pensionable earnings up to the YMPE, and a slightly higher percent B, on the portion of your earnings above the YMPE. Here's the current member contribution rate formula as of July 1, 2024. You currently contribute 8.2% of your pensionable earnings up to the 2024 YMPE, and 10% on the portion of your earnings above the 2024 YMPE. When we converted to a jointly sponsored pension plan on July 1, 2020, member contribution rates have gradually increased on a fixed schedule each July 1st by 0.6% of pensionable earnings, and will continue to do so until the funding for the plan reaches a joint 50-50 employer-member cost-sharing ratio. Employer contributions, on the other hand, are determined by actuarial valuations in accordance with legislative requirements. These valuations are prepared by our external actuary to monitor the funded status of our plan, and they establish the contribution requirements, which is done at least once every 3 years when the valuation is filed with the regulators. Right now, our employers currently pay the balance of this cost until cost sharing is equally reached. As of July 1, 2024, the employer contribution rate is approximately 16.9% of pensionable earnings. This means that for every dollar you contribute to the plan, your employer is contributing $1.91 on your behalf. This rate will continue to be adjusted as we reach equal cost sharing. Next, we'll take a look at how your pension is calculated, but before we do that, it's important to highlight that your lifetime pension benefit is worth much more than the total contributions you make. Most members receive their contributions back in the form of monthly pension payments within 4 to 5 years. Remember, the pension that you'll receive in retirement is calculated by a formula, not what's accumulated in an individual savings account where there is a risk that you might outlive your savings. As a Wise Trust member, you'll know upfront what your pension will be for life. So here's the plan's formula that is used to calculate your lifetime pension. Notice that there are 2 main components here: your best average earnings and pensionable service. Your best average earnings is based on your highest average pensionable earnings over any consecutive 60 months or 5-year period during your last 120 months or 10-year period before you retire. Although the best 5 years of earnings are often your last 5 years, that's not always the case. If you decide to take a lower paying job in the years just prior to retirement, your pension would not be negatively impacted. We would use the best average earnings that would take place earlier to calculate your pension. Pensionable earnings is essentially your base pay. So it does not include things like overtime pay, job differential pay, pay in lieu of benefits, or performance bonuses. A full listing of what is and is not included in pensionable earnings can be found on our website or in the Wise Trust Pension Guidebook. Your pensionable service is the total years, months, and days of service during which you or your employer on your behalf contribute to the plan. And this can include any eligible periods of service that you've purchased or transfer in from another pension plan, periods that you are receiving short-term or long-term disability benefits from your employer's disability plan, where you or your employer are contributing to the Wise Trust plan for these periods, or periods where you're receiving benefits from a WSIB claim, again, where you're contributing to the Wise Trust plan for that period. If you have a part-time service, your pensionable service during that part-time period is calculated as a proportion of the pensionable service that a full-time equivalent employee would earn. But to note, working part-time does not reduce your best average earnings, as we always use the full-time equivalent earnings to calculate your pension. For comparison, let's take a look at two scenarios. Jasmine here joined the plan on January 1st, 1992, and will be retiring on January 1st, 2026. If she works at 100% full-time ratio, her pensionable years of service at retirement, assuming she doesn't have any breaks in her service, would be about 34 years. If she works part-time at 60% for the same duration, she would have approximately 20 years of pensionable service upon retirement, and again, assuming she has no breaks in her service. You can see here how the service is prorated based on the part-time hours and the effect it has on the pensionable years of service. Again, working part-time does not reduce your best average earnings, as we always use the full-time equivalent earnings to calculate your pension. In general, by working and contributing to the plan longer, you get more pensionable service and potentially higher earnings, which increases your overall pension in retirement. Now that you know the importance of pensionable service in determining the amount of your pension benefit, let's talk about how you can ensure you're maximizing it. During your employment, there may be times when you take a leave of absence, like a maternity leave or a leave due to an illness or disability. Or there may have been a time when you've worked for a participating employer, but weren't a member of the plan at that time. As a result, there could be gaps in your pensionable service when you weren't contributing to the plan. Purchasing those eligible employment periods is another way to increase your overall pension at retirement. This is a list of some of the common employment service periods that are eligible for purchase. Periods where you were employed on a temporary contract basis but not enrolled in the plan. Leaves of absences covered under the Employment Standards Act, ESA, like a maternity or parental leave. An unpaid absence due to an illness or disability, or an education or a personal leave. An unpaid period due to a layoff or strike. And lastly, a period of temporary part-time employment where you were a full-time employee, then became part-time for a temporary period, and immediately returned to a full-time employment again. At that point, you're eligible to purchase the portion of service you would have earned had you been full-time during your part-time period. The cost to purchase depends on the type of pensionable service and when you're purchasing it. For certain unpaid leave purchase types like illness, an ESA leave like a maternity or parental leave, or a layoff period, if you initiate the purchase when you return to work within the specified deadline, the cost to purchase is the contributions you would have made during the leave period. Other purchase types like an educational or personal leave or temporary employment period purchase may require you to pay both your contributions and your employer's contributions. Make sure you're aware of the purchase deadlines associated with any leave that you take. If you miss the initial deadline, which is generally a period equal to the length of your leave period starting from the date that you return to work, the cost is the actuarial present value, which represents the full value or purchase price of the benefit and is typically much more expensive. In general, the longer you wait to initiate any purchase, the more expensive the purchase may be. Visit our website, wisetrust.ca, for more details. It's also important to note that purchases can only be made while you're an active member of the pension plan. So you'll need to initiate it before you retire or before you end your employment. Once you submit your retirement or leave your employer, the option to purchase pensionable service is no longer available. We'll show you later in the presentation how you can view any periods of service available for you to purchase in the My Pension Resource self-service website. Next, we'll talk about another way you may be able to increase your pensionable service under the plan. You may have worked somewhere else where you were earning a pension under a former employer's pension plan. In that case, you may be able to transfer the value of your pension earned in a former employer's plan into our plan. Consolidating your pension into one plan may increase the overall value of your pension at retirement. There are strict deadlines involved in this transfer process. You must make your request to transfer your pension value within 6 months of joining our plan and within 18 months of leaving your former employer. Contact our pension contact center for more details to see if you're eligible. The transfer process is a complex one, so please be prepared as it can take up to 1 year to complete the transfer. This is because there is a lot of correspondence that happens between the pension plans and the administrators. Next, we'd like to provide you with an overview of the secure online member self-service site called My Pension Resource. In addition to all of the pension plan related information you'll find on our website, wisetrust.ca, My Pension Resource is your one-stop shop for your personalized pension information and self-serve tools that are all available for all members at any stage of their career and even after retirement. My Pension Resource is easily accessed through our website by clicking on the login button located at the top right corner of the homepage. Here, you'll be able to view your personal account, including your address and phone number on file, and your pension spousal information and designated beneficiaries. You can also run pension estimates using your own up-to-date information and request a quote to purchase pensionable service, initiate your retirement online, view and download your latest annual pension statement, send and receive secure messages to and from our contact center, elect for paperless communication, and access and download forms, and much more. Once you retire, the site allows you to manage and update your personal account information, including your banking information. If you haven't already done so, here's how you can register for My Pension Resource. It just takes 5 easy steps. First, go to wisetrust.ca and click on My Pension Resource in the top corner. Click on the Register Here link just below the login button and enter your ID, last name, and date of birth, and follow the instructions to create your username, password, and security questions. For enhanced security protection, you will be asked to provide an email and phone number for multi-factor authentication. But if you're experiencing any issues, just call the Wise Trust Pension Contact Center for assistance. Once you've logged into the site, you'll see along the top banner that there are 4 main areas: the home page, My Pension, Messages, and Profile. We'll take some time now to show you how to navigate through the site. Let's start by taking a look at the last icon on the right, the Profile section. The Profile section is where you can view the personal information that we have on file for you. You'll see your date of hire with your employer, your plan membership date. This is the date you became a member of the pension plan, your address and phone number, as well as your email addresses. The beneficiaries link will take you to the page where you can view the eligible spouse, eligible children, and designated beneficiary information that we currently have on file for you. To make updates to any of this information, Follow the forms link on the bottom of this page, and it will take you directly to the spousal declaration and beneficiary designation form. Simply complete this form and send it back to the Wise Trust Pension Contact Center. You can also upload a copy to the Message Center in My Pension Resource. However, the original must be mailed to the Wise Trust Pension Contact Center, as we require a wet signature to complete the process. You can elect to receive pension-related materials from the Wise Trust Pension Contact Center, and you can do this by visiting the Communication Preferences page. There will be two options available: receiving the material mailed to your home address or receiving the material electronically via the Message Center. We'll give you details about this feature in just a moment. And the Manage Security page is where you can update your password and security questions. So if you click on the messages icon in this banner, this will take you to the Message Center, which is a great employee self-service feature in My Pension Resource. Here you can communicate electronically with the Wise Trust Pension Contact Center by sending your inquiry directly to them through the secure site, just by clicking on Create New Message. When you receive a response, you will receive an email prompting you to log in and view the message back here in the Message Center. And if you've sent messages to the contact center in the past, you will see all of that correspondence listed here for your reference. Let's move over to My Pension area. Here, you'll see the main self-service functions of the site under My Pension Benefits, as shown here on the left side. This is where you can run pension benefit estimates, compare different scenarios and save the estimate scenarios that you've run, model your retirement income. You can initiate retirement and view the periods of pensionable service that are available for you to purchase. So let's take a quick look under the Purchase of Pensionable Service section. Here you will see all of the periods of pensionable service that are available for you to purchase. To initiate a quote, simply select the period of interest and click on Request a Quote. This will initiate your request, and a buyback quote will be sent to you within 2 to 4 weeks. Going back to the My Pension area, you will find a list of the online resources that are available to you under the Resources section here on the right. Here you'll find your latest annual pension statement, the Pension Plan Member Guidebook, and commonly used forms such as the Spousal Declaration and Beneficiary Designation Form. You'll also find an FAQ section, which has some great pension information as well as our contact information. As you plan for retirement, you'll want to know how much your Wise Trust pension will be. So let's take a closer look at the Estimate My Pension benefit and compare scenario functions, where you can get a personalized estimate of what your future pension looks like at any age, retirement date, or key milestone date, and how that can change based on the different factors and possibilities, such as retiring earlier or later, or future salary increases. This tool will give you some insight into when you might want to start your pension. Remember that when deciding to retire can impact your pension amount, so choose your retirement date carefully. You'll see it will also provide you some helpful information when deciding which surviving spouse option is right for your personal situation. To estimate your pension, you can choose to input either any age at which you'd like to retire, a specific date, or you have the option to select a quick date. The quick dates refer to your key milestone dates, such as your earliest retirement date, your earliest unreduced retirement date, or your normal retirement date. The system is smart enough to figure out your dates for you. You can also enter an annual salary increase rate assumption up to 3% and the date of birth of your eligible spouse to see the surviving spouse options. And if you do have any service periods available for purchase and want to know the impact on your pension if you were to make that purchase, click on Model Purchase of Pensionable Service to select the periods you'd like to include in your pension estimate. You will see in this example that this member has a few periods of service available for purchasing. Visit the Purchase of Pensionable Service screen to initiate the quote for these periods if interested. Once you've entered all of your assumptions and selected the buyback periods to include in your pension estimate, click on the Estimate Pension Benefit button. Here's what the pension estimate results look like. In this estimate, the member has an eligible spouse, so it details the surviving spouse options, also referred to as joint and survivor options. The estimated monthly lifetime pension amount that you'll receive at the retirement date is entered is shown under the column labeled payable to you. This option provides for 66 2/3 of your lifetime pension to continue to your eligible spouse if you were to pass away before your spouse, where that amount is shown under the spouse column. You can also choose to provide a higher survivor pension to continue at 75% or 100%. Notice how the pension paid under the payable to you column is reduced slightly in this example to pay for the higher 75% or 100% pension amount that would continue to your eligible spouse. And in this example, you'll see that since the member's retirement date is before age 65, the member is also entitled to receive a bridge benefit paid until age 65 or death if earlier. But notice that under the spouse column, the bridge benefit does not continue to the spouse if the member passes away first, since the bridge benefit is only payable to the member's lifetime only. We'll get into details on the bridge benefit later in the presentation. You can also choose up to 3 estimate scenarios to do a side-by-side comparison to see the impact of your varied assumptions. For example, you can compare what your pension would be if you retired at your earliest retirement date, your earliest unreduced retirement date, and your normal retirement date to see the difference in your pension. Or you can compare estimates to determine the impact of retiring 1 or 2 years earlier or later than you originally planned, or see the impact of using different salary rate, increase rate assumptions, or the difference in your pension when you include a period of pensionable service that you're looking or thinking about purchasing. As you can see, this is a really helpful tool when planning for your retirement. Your pension from the plan is considered taxable income like most other sources of retirement income like CPP, OAS, RRSPs, and the registered retirement income funds. We are therefore required to deduct taxes from your pension payment from the plan based on basic federal and provincial income tax table rules. It's important to keep in mind that when you're using the pension estimate tool or when you're viewing any communication from us, the pension amounts displayed are the estimated gross monthly pension amounts, unless otherwise noted, as the required income tax withholding has not yet been deducted. If you'd like to estimate the tax withheld from your pension, please visit canada.ca and search on Payroll Deduction Calculator. This is a tool that will estimate the amount of tax that would be deducted from monthly pensions. So now I'll pass it over to Marcia to talk about life and career events and retirement.
Great, thanks, Nuruja. So next, we'll take a look at some life and career events that may impact your pension, like a relationship change, taking time off work due to a disability, or leaving your employer. Maybe you're getting married or entering a common law relationship, or maybe you just have questions about what happens to your pension during a separation or divorce. If your relationship status changes and you need to update your personal information or have questions, call the Wise Trust Pension Contact Center. Forms to update your spousal status and designate your beneficiary under the pension plan can be found on My Pension Resource or on our website. You should name a beneficiary and review your designations wherever your personal circumstances change. Your eligible spouse, as defined under the plan, will automatically receive survivor benefits when you pass away. We'll talk in more detail about survivor benefits and who qualifies as an eligible spouse later in the presentation. If your spousal relationship ends, your pension benefit may be affected. Under the Ontario Family Law Act, pension benefits earned during your relationship may be included in the division of family property. What this means for you will depend on your own particular circumstances. Before you divide your property, to start, you'll need to know the value of the pension assets you accumulated during your relationship. And this is done by applying for a statement of family law value. We recommend you get professional, financial, and legal advice before making any decisions about your pension. Please contact the Wise Trust Pension Contact Center for more information. If you're away from work and receiving benefits from your employer's short-term disability plan that are paid to you through your employer's payroll, contributions to the plan will be automatically deducted from those pensionable earnings. This means that you will continue to earn pensionable service. For WSIB employees, WSIB will pay your required contributions on your behalf starting on day 41 of your absence for the duration of the short-term disability period. Not all of our employers pay short-term disability benefits directly to their employees through their regular payroll. You may receive these benefits from an insurance carrier, and in that case, you may instead purchase those short-term disability periods when you return to work. Make sure you contact the Wise Trust Pension Contact Center or visit My Pension Resource as soon as you return to work. And for more information on your employer's short-term disability plan benefits, please reach out to your respective HR departments. If you're receiving long-term disability plan benefits, your employer makes contributions to the plan on your behalf. You continue to earn pensionable service, even though you're not actively at work, until you retire, reach age 65, or pass away, whichever occurs first. This only applies if your employer maintains a long-term disability plan. Another change that might happen in your life is a career change. When your employment with a participating employer ends, your active membership in the plan also ends. At this point, you'll need to decide what to do with your pension benefit. If you're under the age of 55 and not yet eligible for an immediate pension from the plan, you'll have 3 options upon termination. You can choose to defer your pension, meaning you can leave your pension in the plan until you become eligible to start receiving it, which can be as early as age 55, but no later than age 65. When you're ready to retire, you'll have a predictable lifetime pension that's adjusted for inflation. You will also have the option to transfer your pension value into another plan if you leave to go to another employer who has a pension plan that is willing to accept the transfer. And in that case, you'll need to contact that pension plan's administrator for details. The third option allows you to transfer the value of your pension into a locked-in retirement account where you will then be responsible for investing the funds and taking the investment risk and any associated management fees. If you choose this option, you are giving up your right to a guaranteed monthly pension from our plan that's payable for your lifetime and offers inflation protection and survivor benefits. It's also important to note that these funds are locked in, meaning the value of your benefit is not available to you as an immediate cash payment. The funds must be transferred to a locked-in retirement savings vehicle that is intended to provide you with retirement income in the future. That being said, the Income Tax Act does limit the amount that can be transferred into a registered vehicle, so there may be a portion of your benefit that is in excess of the maximum transfer value amount. And this excess amount will be paid to you in cash, subject to withholding tax. And this cash payment is classified as income and is taxable at your personal income tax rate in the year you receive the payment. The cash payment will also reduce the amount you have available in retirement. You should also consider that if you meet the eligibility requirements of any post-retirement group health benefits program, provided by your employer and you choose to transfer the value of your pension out of the plan, you may no longer be eligible for this post retirement health coverage. For eligibility inquiries specific to your circumstances, again, you must contact your benefits and HR departments for more information. So, as you can see here, deciding whether to keep your pension in the plan or transfer it out is an important decision, one with potentially significant financial consequences for your financial future. Given that, we strongly recommend that before making any decision, you seek independent, unbiased advice from a qualified financial advisor who will act in your best interest. We have some helpful information on our website, wisetrust.ca, that can support you and your advisor in that decision. If at the time that you terminate your employment, you've reached the age of 55, or you're eligible for an immediate unreduced pension under the plan's early retirement provisions, you must leave your pension in the Wise Trust plan. You'll be given the choice to either start it immediately, defer it to a later date, or if you leave to go to another employer with whom we have a reciprocal transfer agreement with, you can elect to transfer your pension benefit to that employer's pension plan. Note that transferring the value of your pension to a locked-in retirement arrangement account is not available to you at this point. So now we'll talk a little bit about retirement. Choosing when to retire is an important decision, and your Wise Trust pension is only one piece of the puzzle. Other sources of income like government benefits such as the Canada Pension Plan or other retirement savings and retirement lifestyle choices all need to be considered. The right time to retire will not be the same for everyone. Your unique personal circumstances will help to determine when the right time is for you. And the key first step is taking the time to learn about your pension and the important role it can play in helping you build financial security for your retirement. So let's start by reviewing your retirement options under the plan. You'll have the flexibility to start receiving your lifetime pension as early as age 55 or as late as age 71 or anywhere in between. The choice is yours. You can retire at age 55, but you can also let your pension grow by continuing to work until you're ready to retire. Different retirement dates can impact your overall pension amount with factors like your age, eligibility service, and other considerations playing a role. So it's important to understand each of these options. You can retire with an unreduced pension on or after your normal retirement date, which is at age 65. Retire with an unreduced early retirement pension once you've met the plan's eligibility rules, which we often refer to as Factor 85 or the 60-20 rule. If you haven't yet reached your earliest unreduced retirement date, you can retire with a reduced pension that can start as early as age 55. So let's take a look at these options in more detail. The first day of the month following age 65 is what we refer to as your normal retirement date, which means you're eligible to receive an unreduced lifetime pension that's calculated in accordance with the plan formula. If you want to continue working beyond age 65, your pension will continue to grow until you do retire, or if earlier, to the end of the year in which you turn age 71. And that's when you are required to start your pension, even if you continued working. You can choose to retire earlier than age 65 without any reduction to your lifetime pension if you qualify under one of these early unreduced retirement rules. So Factor 85, this is when your age, when added to your years of membership or pensionable service, equals at least 85 points. So for example, you can retire as early as age 53 if you have 32 years of pensionable service. The 60-20 rule is when you're at least 60 years old and you have at least 20 years of membership or pensionable service in the plan. The date on which you first become eligible for an early unreduced pension under the plan is typically referred to as your earliest unreduced retirement date, and you can find that date along with the other key dates on your annual statement that you receive every year in June. And similar to your normal retirement date, if you want to continue working beyond your earliest unreduced retirement date, your pension will continue to grow since you'll earn additional pensionable service. If you don't qualify for an unreduced pension under the Factor 85 or the 60/20 rule, you can still retire anytime after age 55. However, your lifetime pension that you've earned to that date will be reduced by 3% for each year that you retire prior to the date you would have qualified for an unreduced early retirement or turned age 65, whichever is earlier. And this is to reflect the fact that you're starting your pension earlier and will receive it for a longer period of time. So for example, if you retired 2 years prior to your unreduced retirement date, your lifetime pension would be reduced by 6%. So that's 2 years at 3% each, which represents 94% of your pension. And this reduction is made to reflect the fact that you are receiving your monthly pension payments 2 years earlier. If you retire early before age 65, you'll receive a temporary bridge benefit that's paid monthly in addition to your lifetime pension from the plan. Your bridge benefit will continue to be paid until age 65 or until you pass away, whichever occurs first. The bridge benefit helps level your retirement income until age 65, when you can collect an unreduced pension from the Canada Pension Plan. The bridge benefit doesn't stop if you take your Canada Pension Plan benefit early. There is no impact to your Wise Trust pension, as CPP benefits and pension benefits paid from our plan are completely separate and independent of each other. To illustrate your Wise Trust pension benefits, you'll see here that if you retire early before age 65, you'll have two parts to your pension paid from the plan: your lifetime pension and a temporary bridge benefit. Your lifetime pension and the bridge benefit will both start on your early retirement date and will continue until the first of the month in which you turn age 65, and which at that point, the bridge benefit stops. But your lifetime pension will continue to be paid for the rest of your life. If you retire after age 65, there is no bridge benefit payable. Next, we'll talk about some really important key features of the plan, like inflation protection and survivor benefits. When you retire, the negative impact of inflation on your pension will be partially offset by your plan's inflation protection, which will help your pension retain its purchasing power while the prices of goods and services increase over time. And once you retire, every January 1st, your pension will be inflation adjusted, or what we refer to as indexation. And that's based on a formula that is set out in the plan. So let's move over to survivor benefits. Survivor benefits help provide financial security for your loved ones, whether you pass away before or after you retire. And this benefit is provided to you at no additional cost and is available to your eligible survivors. The type and amount of survivor benefits provided under the pension plan depend on whether you have an eligible spouse, as defined by the plan, or eligible dependent children, and whether you've started receiving your pension when you pass away. First, let's look at the definition under the plan for the three types of survivor beneficiaries and who qualifies under each. The first is an eligible spouse. Under the plan, this is defined as the person you are married to, or if you're not married, it's the person you have been living with continuously for at least 3 years, or less than 3 years if you're the parents of a child. An eligible spouse takes priority to survivor benefits over any other survivor beneficiary upon a member's death. This means your eligible spouse will automatically receive 66 and 2/3 of your lifetime pension for the rest of their life if you pass away before them. However, if prior to retiring, a member has an eligible spouse that is living separate and apart from the member, and the member passes away, that separated spouse does not have an entitlement to survivor benefits. The second type of survivor beneficiary under the plan is an eligible child. This is where you're a parent of a child who is either under the age of 18 or 18 years of age or older, but less than age 25, and they're attending full-time school, or 18 years or older and has a physical or mental disability that prevents them from earning a living. And the third is a designated beneficiary or more than one beneficiary who may be eligible for benefits under the plan. A beneficiary can be a person, such as a child, or an organization, such as a charity. If you choose to name multiple beneficiaries, any death benefit payable to the beneficiaries will be split as per the allocation on your designation form or divided equally among your beneficiaries if there is no allocation provided. If you don't designate a beneficiary or your beneficiary passes away before you, any benefits payable when you pass away will go to your estate. That's why it's so important that you review your pension beneficiary designations on a regular basis and update them as necessary to ensure we have the accurate designations on file for you. It's not necessary to name your spouse as your designated beneficiary, since, as we mentioned, under the pension plan, your eligible spouse will automatically receive the survivor benefit. If you don't have an eligible spouse, or your eligible spouse chooses to waive their right to their survivor benefit, and you don't have any eligible dependent children at the time of your passing, your designated beneficiary is next in line for the death benefits. As we showed you earlier in the presentation, you can view your eligible spouse information and the pension beneficiaries you have on file, as well as obtain the spousal declaration and beneficiary designation form to make any changes if or when needed on the My Pension resource site. You may be wondering what happens to pension benefit you've earned when you pass away before you start your pension. In that event, your eligible spouse will have the option to either an immediate or deferred monthly pension, or take the lump sum commuted value of your pension, which can be transferred to their RRSP. And if your eligible spouse chooses an immediate or deferred monthly pension and you also have eligible children, your eligible children may be entitled to receive a pension of up to 10% of your lifetime pension for as long as they remain eligible children. If you do not have an eligible spouse but do have eligible children, your eligible children will receive a monthly pension equal to 66 and 2/3 of the lifetime pension that you earned, divided equally for as long as they remain eligible children. And if you don't have an eligible spouse or any eligible children, the value of your pension will be paid directly to your designated beneficiary, or if there's no beneficiary designated, the payment will be made to your estate. So what happens if you pass away after you retire and have an eligible spouse or eligible children? As mentioned, your eligible spouse, who is the spouse at the time of when your pension starts, they will automatically receive a spousal pension equal to 66 and 2/3 of the lifetime pension you were receiving, and that percentage will continue for the rest of their life. If a bridge benefit is being paid to you at that time, the bridge benefit will not continue to your spouse, as the bridge benefits are only paid for your lifetime. When you decide to retire, you will be given the option to choose a higher survivor pension to continue to your eligible spouse at either 75% or 100% of your monthly lifetime pension. but that will result in a slight reduction in the lifetime pension that you will receive in retirement, and that's to reflect the additional benefit that would continue to your spouse in the event of your passing. And just to reiterate, it's your eligible spouse at retirement who remains entitled to the survivor pension that's payable upon your passing, even if you later divorce, separate from your common law spouse, or remarry. If you also have eligible children, they may each receive a pension of up to 10% of your lifetime pension for as long as they remain eligible children, which is until age 18 or age 25 if they're attending full-time school, or if they have a physical or mental disability that has prevented them from earning a living. The amount they receive, if any, does depend on the survivor option chosen at retirement and the number of eligible children. If you don't have an eligible spouse, but do have eligible children at the time of your passing, your eligible children will receive a pension equal to 66 2/3 of the lifetime pension you were receiving, and again, divided equally among them for as long as they remain eligible children. If you don't have an eligible spouse or any eligible children, your pension will not continue as it is only paid for your lifetime. However, if the contributions that you made to the plan plus interest are greater than the total pension payments you received in retirement prior to your death, a payment of that excess amount will be made to your beneficiary. And if no beneficiary is named, the payment will be made to your estate. Survivor benefits for a spousal relationship beginning after retirement are not funded by the plan. Therefore, your pension will be actuarially reduced to provide survivor benefits to your post-retirement spouse. You must make an election to add this survivor protection within a 6-month period, beginning 1 year after you begin a relationship with your post-retirement spouse. Now that we've covered the plan's key features, we'd like to leave you with a few important reminders as we wrap up the presentation portion of the session. Just a few key reminders that we would like you to take special note of. First, always remember to keep your personal information, such as your mailing address and phone number, updated through your employer. This information is sent to us by your employer to ensure you receive important pension-related information. You can update your personal email directly through My Pension Resource under the Profile section of the website that we showed you earlier. Keeping your email updated is especially important as we increase our paperless communication efforts. If in the future you no longer work for one of our participating employers and have a pension benefit that remains in the plan, it is important that you contact us directly to make any changes to your mailing, phone, or email address through My Pension Resource or by calling the contact center. We can't stress enough how important it is to keep your spousal and beneficiary information up to date at all times. Review your designations on a regular basis and update the information as needed. And you can view your current pension designations online under the profile section on the My Pension Resource site or on your annual pension statement that you'll receive each year in June. It's important to note that these beneficiary designations are strictly for pension purposes and they don't relate to, they're not related to any other life insurance that may be offered through your employer. You will need to contact the administrators of those benefits to update your designated beneficiaries under those plans. And by keeping your spousal and beneficiary information up to date, you'll ensure that any eligible pension benefits will be distributed according to your wishes. And lastly, when planning for your retirement, we strongly recommend getting qualified, unbiased advice to help with your overall retirement plan. A qualified financial advisor can help you determine how much retirement income you'll need to help meet your retirement needs and goals. In addition to your Wise Trust pension, consider other sources of income, including government benefits like CPP and OAS, your personal retirement savings, or employment income from a part time job, for example. Consider all your retirement income sources and personal circumstances carefully and obtain estimates before making any decisions. And for information on CPP and OAS benefit estimates, you can visit canada.ca or visit Service Canada. Here's our contact information. You can call or send a secure message to our contact center through My Pension Resource. The Wise Trust Pension Contact Center can be reached at 1-855-242-1526, and they are available Monday to Friday from 8:30 a.m. to 4:30 p.m. Make sure to have your 5-digit employee or pension ID handy when you call. If you're interested in more information about the plan, such as the funded status or our investment performance, our 2023 Highlights for Members report is available on our website. So that concludes the presentation portion of our session.